Does high options premium ever signal lower seller risk? Imagine you're looking at an options trade and notice the premium is very high. Does that mean the person selling the option is safer? Not necessarily. Let's break down what a high premium really tells us. In options trading, the premium is the price paid by the buyer to the seller for the right to buy or sell an underlying asset at a specific price before a certain date. This premium has two parts: intrinsic value and extrinsic value. Intrinsic value is how much the option is worth if it is in the money, meaning the current stock price is above or below the strike price for calls or puts. Extrinsic value is everything else, like how much time is left until expiration, implied volatility, dividends, and interest rates. When the premium is high, it usually means there is a lot of extrinsic value. This can happen when there is a lot of uncertainty about the stock's future or when implied volatility is high. For example, if a stock is expected to move a lot in the near future, options tend to have higher premiums because buyers are willing to pay more for the chance to profit from big moves. Now, for the person selling the option, a high premium might seem attractive because they get more income upfront. But it does not automatically mean they are safer. In fact, selling options with high premiums can be riskier. If the stock moves sharply against the seller's position, they could face large losses. For example, if you sell a call option with a high premium and the stock price skyrockets, you might have to sell the stock at the strike price, even if the market price is much higher. That could lead to significant losses. The key is that a high premium often reflects higher potential for large price swings. So, while the seller gets more money initially, the risk of a big move against them is also increased. It's important to remember that the premium is a reflection of market expectations and volatility, not a guarantee of safety. In practical terms, traders who sell options with high premiums need to be very careful. They should have a clear plan to manage potential losses and understand that higher premiums often come with higher risks. They might use strategies like spreads or hedging to limit their exposure. To sum up, a high options premium does not mean lower risk for the seller. It often indicates higher expected volatility or uncertainty, which can lead to bigger losses if the market moves unfavorably. Always consider the overall market conditions and your own risk tolerance before selling options, regardless of how high the premium appears.